to learn about finances and investments with the help of my mom and dad. Today, we are going to continue reading the little book of value investing. This time, I am going to read the third chapter, Belt and Suspenders for Stocks. Okay, let's read. Also, if I can learn this, you can too. Okay, let's read. Investing in stocks is not like putting your money in a savings account that pays 10%. Naturally, returns will fluctuate from year to year, sometimes dramatically. The 10% return is only an average of some bank-up years and some gut-wrenching years. What would you like if some mechanism that forces you into the market when stocks are cheap and eases you out when they are dear? Getting in at the top of a stock market cycle produces better return than getting it in at the top. While Graham did not make pronouncements about the level of producer stock market, he had a formula for identifying whether individual stocks were cheap or expensive. He used this formula to guide his individual stock selections. Basically, Graham wanted to buy stocks selling at 2/3 or less than their intrinsic value. This was his margin of safety, the belt for his stocks. It is a margin of safety for a couple of reasons. First, if he was correct in his statement of intrinsic value, the stock could rise 50% and still not be overvalued. Second, if the stock market hit rough patch, he had a comfort of knowing that what he owned was unlimited worth more than he paid for it. A bargain of safety gives you an edge over just blindly buying stocks or an index fund. Over the years, our margin of safety in the stocks had override more of our overall gain that has underlying growth in the value of a business. If we buy the stocks of ABC Ice Cream Corporation for $6.50 and we believe it is worth $10, we have potential gain of $3.50. If during the period we own the stock, the company can grow its business by 10% so that the stocks become worth $11 more. $11. If we have a larger potential again. However, the greatest part of that gain has come from buying the stocks cheaply in the first place. If an investor had bought the same stock for $10 and his potential gain might only be $1, buying dollars for 66 cents has produced market-beating returns for many value investors. Buying stocks at a discount of their intrinsic value not only the belt for stocks, but also serves as a set of suspenders for what it prevents investors from doing. We have generally approved investing in companies that we have a lot of debt related to their net worth. This bargain of safety provides assurance that the company will survive during poor economic times, such as recession. We all know people who seek the maximum mortgage on their house, run up their credit cards, debts to the limit, and live from paycheck to paycheck. We also know people who maintain a rainy day fund to get through unforeseen through patches. If the guy with all debt loses his job, he may lose his house as well. The guy with the rainy day fund can survive until he gets another job. The same is true for companies. A company lot of debt, where hearing barely cover the interest expense is a far riskier investment than a company with some extra cash on its balance sheet and is about to have a cushion, a bargain of safety to get you through the bad times that people and companies inevitably encounter. That is the it of me reading. Now, let's see the most important things of the third chapter. 1. Warren Buffett said the first rule of value investing is 1. Don't lose money. And the second rule is don't forget rule 1. Benjamin Graham said buy stocks selling at 2/3 or less of their intrinsic value. This was his bargain safety. The belt for his stocks. Number 3. Another principle of bargain safety is diversification. We must have a broadly diversified portfolio, both in terms of the number of stocks and about different industries. 4. Following the principles of value investing, if stocks are cheap, you buy them. You forget all the noise that is swirling around you, and you take advantage of stocks on sale. The reverse is also true. This is an example. Let's see the second most important thing of the chapter. Buy stocks selling at 2/3 or less than their intrinsic value. Basically, that's buy at 33% on sale or less. If you buy the company ABC Ice Cream at $6.50 and you believe that this company is worth $10.10, you are buying with a bargain safety of 35% and potential gain of $3.05 per share. But if you buy at $9, you are buying with a safety bargain of just 109%. This is too low. I hope you understand the video, and enjoyed the video. I love you guys. Bye. And remember, if I can learn this, you can too.